Hello and welcome to this CNBC Africa special broadcast of Nigeria's Monetary Policy Committee meeting, where Nigeria's Central Bank Governor Godwin Emefiele will outline the position of the MPC after its fourth meeting of the year. I am Wole Famirewa and thank you for joining us. Nigeria's economy managed to continue its slow progression out of its second recession in the last 4 years, recording a 0.5% growth in first quarter GDP. While we're still awaiting the second quarter GDP numbers, however, inflationary pressures are still a concern, although Nigeria witnessed some moderation in the month of June, with headline inflation at 17.75%. Now, the general consensus from analysts that we have spoken to is that the committee will maintain the status quo and keep its monetary policy rate unchanged at 11.5%, but could we be in for a surprise? Bismarck Uwani, the CEO of Financial Derivatives and member of the Presidential Economic Advisory Council, Emmanuel Odiaka, the CEO of ECOP Capital, and from South Africa, we have Lawrence Hamza, head of Africa Trading at Rand Merchant Bank, joining me to preview the MPC's decisions. Gentlemen, thank you so much for joining us today. I'd like to start with you, Bismarck. At the last MPC meeting, the Central Bank Governor really outlined the twin problem confronting the Nigerian economy. And it's all related around stagflation, where we're seeing high inflation and still some contraction in GDP. Let's start with the inflation number and just get your perspective on the trend that we're seeing there. And what is your outlook for inflation, and how do you think that will play in the minds of the MPC as they consider the economy?
Yes, we are told that the official rate of inflation has actually declined. We are also aware that there's some inflation stoking factors that have actually receded recently. So I don't think price inflation is going to be a major consideration. The only thing is that to the extent that there's a risk that the inflation trajectory could actually reverse itself very quickly, the central bank is not likely, in my judgment, to make any move that will actually preempt the inflation trend as we see it. In other words, there's the fear of inflation, and also there's the fear of output contraction. So the central bank, in most likely outcome is that there will be status quo, maintaining the status quo, so that we can see what happens on August 26th when the GDP numbers come out.
Right.
And also we can see some direction as far as unemployment is concerned.
So that view is in line with what many analysts are saying, but just to clarify, what is your expectation for inflation over the rest of the year? We've seen that moderation over the last few months, but how much lower do you anticipate it will go?
I do not think it will go much lower. Why do I say this? Because the factors that lead to inflation, money supply growth is at about 19%, while GDP growth is about 0.5%. Normally, since output is growing at a much slower pace than money supply, that's inflationary. Two, the exchange rate pass-through, because one, the price of the currency is now in the parallel market trading about 504. In the INE window is trading about 411. The pass-through effect of this on prices is beginning to manifest itself. So one, pass-through of prices. Two, money supply growth. Three, logistics costs because of insecurity, and also the price of diesel, which powers the trucks. Diesel is trading today at 285 naira per liter. And when you factor, there's an anchor between the price of diesel and the price of commodities that are powered by such trucks. If you put all of these things together, we think in our own projection, in the Lagos narrow basket that we use, we see inflation going as high as 18.1, 18.15, then declining when the harvest starts in September, declining somewhat and moderating towards 16, 17. But I don't think we'll close the year in anything below 16.5%.
All right.
This is what the World Bank is saying.
Okay, let's shift the conversation now to the Forex market. And I want to start with you, Lawrence. Now, the reason I come to you is because you will be speaking largely for foreign investors here, at least for the sake of this conversation. And I wanted to get your perspective on what's top of mind for those investors right now as they consider bringing fresh capital to Nigeria. We do know that foreign portfolio investment flows have been a major source of supply to the foreign exchange markets, which have stabilized the exchange rate. We have seen that really taper over the last 12 months or so. What do you think foreign investors are looking for before they bring fresh capital here?
Yeah, thanks. I think in our view, we also think that the MPR rate will be unchanged. And as you mentioned, I think one of the things that we're looking for in this MPC statement is any guidance on potential changes to FX policy or FX rates going forward. I think, as you mentioned, foreign portfolio flows have slowed. What a lot of foreign investors are looking at the moment is the fact that you see these twin rates, where the parallel rate is close to the 500 level and the INE window is close to 411. So that speaks to potential a gap in the fair value to where FX would make sense. I think for us also, as you mentioned, the drawdown in FX reserves over the last few months have been concerning. On the positive side, I think what we also look forward to is the potential Eurobond issuance coming up in the next few months, and also a potential SDR drawdown. So a buffer of reserves and a potential adjustment of the FX rate to more fair value levels, I think would see investors get more comfort around bringing money back in.
Okay, but do you think that foreign investors would like to see an uptick in rates? We've been talking about the inflation outlook, and as Bismarck mentioned, we don't anticipate a major moderation from where we're at right now. Do you think that foreign investors will be looking for rates much higher than this? Or do you think if we can fix those issues that you've spoken of concerning the foreign exchange markets, that could be a big enough incentive to bring the flows back?
Yeah, look, I think the FX consideration is one leg of the puzzle. If you look at the rates view or outlook in the last couple of months, or the rates trend rather, we've seen rates trend lower again in the fixed income markets. And that's a result of increased liquidity, I think limited investment options for local fund managers and institutional investors, which has seen rates trend back to single digits on the OMO curve and low teens in the long end of the curve. Now, as a relative value play, if you look at both the FX picture and the rates still being in effective negative real rate territory, which is something that's not really a metric that we tend to consider when investing in these markets. But I think it's definitely something that lowers the rank of a Nigerian investment relative to its peers at the moment. So I think there needs to be an adjustment higher in rates. The other thing that is a bit of not a concern, something that we do look at is the various instruments that are in the market at the moment. You've got the OMOs, you've got the NTBs, you've got the FGNs, you've got the special OMO that was recently issued to banks. So, and these all trade at different rates at different times due to different dynamics. So I think if there's clarity around those dynamics as well, that would also give more comfort in terms of investment back into Nigeria.
All right, thank you so much, Lawrence. Let me move over to Emmanuel now. And Emmanuel, you're on the ground, so you see the dynamics much closer than perhaps Lawrence does. And I want to get your thoughts on some of the points that he has raised in terms of the concerns of investors. And to that, I want you to now begin to speak to your thoughts on the outlook for the foreign exchange rate. Because he mentioned that, that huge disparity in the parallel market rate and the official rate is a big concern. And to some extent, it speaks to an adjustment that foreign investors would like to see first before they perhaps bring their money here. Would you say that adjustment is inevitable, given the dynamics we're seeing with the FX reserves at the moment, and then, of course, just the supply of foreign exchange in general?
Thank you, Wale. Yes, obviously something has to give way at this point. We have heard from the last MPC where the governor hinted on the possibility of rate normalization at the fourth quarter, although he was at that point mentioning global trends in developed markets. But he also did hint that it's a consideration in the future, although he mentioned that it's an expectation that should be watched closely so that monetary gains in the past 1 year is not reversed. So moving forward into the FX market equation, yes, everybody is of the opinion that there has to be some normalization and some equilibrium at this point. The gap, obviously, between the parallel market rate and the official rate is wide enough to give concern to any foreign investor. And so it's it's a segment that is being watched closely to see exactly where the CBN is shifting into. From what we have right now, obviously, market is quite tight in that segment of the market, and the liquidity flows to discerning users of FX are complaining. So we have seen the effect in the purchasing managers index, where it decelerated in June from 51.1 in May to 48.8 percentage points in June. So that's a reflective that the manufacturing sectors are feeling the pinch of the tightness in the FS market as well. So we think the Apex Bank should be looking at measures to see proper liquidity boost into this segment of the market. And FPIs will be watching that segment closely, because we are aware that a whole lot of investors, hot money investors that invested in the economy, or foreign portfolio investors that invested in fixed income assets, are still having difficulties in pulling out their funds. So there has to be some gap bridging in that market to bring some comfort before we start seeing inflows.
Right. But if we can be more specific right now, and prior to our broadcast today, I was speaking to some traders, and there is a view in some quarters that it's inevitable that if the central bank sustains its current policy in terms of maintaining the I&E window rate somewhere around 4.11 and allowing the parallel market rate to more or less define itself, we are going to see further weakness in the parallel market rate. Would you agree with that sentiment? And if not, why? That's what you, Emmanuel.
Well, talking about the parallel market rate, it's going to be difficult entirely to continue to look at the I&E window and put aside the parallel market rate, because these are the rates that outsiders outside the shores of this country will continue to consider. Although the Apex Bank seems to dampen the availability and the legitimacy of this market in most times in their consideration, but that is the effective rate at which Nigerians are buying foreign exchange in their transaction, aside from funds that they get from the Apex Bank. So looking forward, we want to see stabilization. We want to see a single exchange rate, which is where the Apex Bank is going, for people to have more comfort.
All right, Bismarck, I think we'll be going to the central bank governor shortly, but let's now talk about the economy and fiscal policy. The debt situation in Nigeria is one that I think is concerning a lot of people, but someone has flipped that argument and said what we have is a revenue challenge, not really a debt problem. Would you agree with that? And what do you think are the implications of this revenue challenge for Nigeria going forward with respect to the debt markets?
First of all, it's not either or. The truth is that you have a debt optimization problem, but you have a revenue mobilization problem. So you have components of both. So I would say that you've got to address your revenue on one hand, and you've got to address the use of the debt. What assets are you using the debt to acquire? Does it increase the productivity of Nigerians? If, for example, you borrow for a bridge that is not completed, it becomes a negative multiplier on capital stock. So I think that has to be clear. But I want to use 1 minute to go back to the exchange rate differential, which we're talking about. And that is this. The difference, the IMF says that there's 18% of our valuation. We see the difference in money supply growth of 19% and GDP growth of, so there's 18.5 to 19% of our valuation. That is the difference between 411 and 505. That is what it says. But if you take the difference between interest rates and inflation, the inflation rate is about 17 or 18%, and the interest rates for for treasury bills, 1 year treasury bills is about 9%. Therefore, there's a 10% differential between interest rates and inflation. That 10% gives you 50 naira on the 411. So all things being equal, you should be seeing a rate that gravitates between 490 or 500 on the parallel market and 460 or 450 in the official market. Using the crawling peg, you might be able to get there, but definitely, if you can increase the supply of forex into the market, that will bring the parallel market to appreciate. But at the same time, you now need to increase interest rates on instruments to ensure that you increase the propensity to save and reduce the propensity to consume, and that will bring inflation to equilibrium. Thank you.
Okay, Lawrence, I want to come back to you and just test the appetite of foreign investors to invest not just in Nigeria now, but in frontier markets in general, given all we know about how the pandemic is progressing across the world. Of course, there are fresh concerns now about a third wave and how serious that would be and the implications for economies. Do you get the sense that some investors are simply just pausing and waiting to see how things play out, or do you think there's still that momentum in terms of investments across frontier markets right now? Because the reason I ask that question is because there could be some arguments within the central bank, for example, that regardless of what we do right now, those foreign flows may not come simply because of how investors view frontier markets right now.
Yeah, look, I think there's still quite a bit of funds in the world that need to find a home. I think what's been happening in recent months in frontier markets and in Africa, what we've seen is investors are starting to be a lot more discerning on where they actually look at putting their cash. They're looking at the risk-reward ratios more closely than they were used to probably in the past. I think from our perspective, when we look at allocations across the continent now, we certainly tend to look at FX stability, FX fair value, and then obviously the rate of return. So in some markets, in for instance, neighboring Ghana, where the yields have been close to 20% a couple of months ago across the curve, we've seen a resurgence in investment in that market on the back of FX stability and some FX normalization as well. So investors are comfortable in investing because the yields, the risk reward on the yield perspective is there, and FX are slightly more fair value levels. If we look at another very popular emerging market, or frontier market rather, Egypt, we've seen post-COVID, initially we saw quite a bit of outflows out of that market, but I guess in the last probably 12 months since the initial waves of COVID, we've seen all that investment return and then some, and FX rates actually go back to pre-COVID levels. So I think the investor appetite is still there. There's still a lot of money that needs to find a home. If you look at the moves in international rates markets, there has been a bit of uncertainty around the reflation trade, but even then, that's starting to wane a little bit. So investors sitting on cash still need to invest somewhere, and I think that they're just looking for markets where the risk-reward sentiment or metric makes more sense for them.
Well, just a quick question, because we do have to go to Abuja shortly, on how they're viewing the political risk in Nigeria, the insecurity. To what extent do you think that's on the minds of investors? Because many will argue that we have seen this for at least a decade in Nigeria, even though it had been somewhat isolated to the northeastern part of the country. Now it seems to be a little more widespread.
Look, it's always going to be a concern. Stability in a market is always something that you would need to look at when investing. But I think from a pure investor perspective, the macro fundamentals and the rates of return are something that's more relevant in the short term. I think this is more relevant probably for your long-term infrastructure portfolio flows than for the investor set.